Hello, everyone. Thank you for joining us for our presentation, What Executives Need to Know About the Future of Taxes, presented by Professor Jennifer Blouin from the Wharton School of the University of Pennsylvania in collaboration with Ivy Exec. This is the second Wharton webinar in the series of 3, and we will be notifying you of the upcoming class led by Wharton faculty members in the weeks to come. My name is Mariana. I'm on the higher education team here at Ivy Exec, and I'll be helping to moderate today's session. Before we begin, I have a few brief housekeeping items for our audience. First, all attendees are currently in listen-only mode. However, we do encourage you to engage in this session by asking questions to our presenter, which you can do using the question box in your GoToWebinar control panel. We do encourage questions during the presentation, and we'll also have a formal Q&A session during the last 15 minutes of the webinar. Additionally, we are recording today's session, so you can look forward to receiving a copy of the recording via email in the coming days. And now I will pass it on to Peggy Bishop-Lane, Vice Dean of the Wharton MBA Program for Executives, who oversees both the Philadelphia and San Francisco programs.
Great, thank you so much. Welcome to today's webinar, everyone, sponsored by the Wharton MBA Program for Executives. As Mariana said, I'm Peggy Bishop-Lane, the Vice Dean of the program and an accounting professor. The Wharton MBA Program for Executives is one of 2 ways that a student can earn the Wharton MBA degree. Our program is suited for mid-level and executive-level professionals in a variety of fields, industries, and functions, including media, finance, healthcare, government, engineering, entrepreneurship, and data analytics. The program is in an every other weekend format in both Philadelphia and San Francisco. And if a full MBA degree isn't for you, Wharton also offers an extensive series of executive education courses through our non-degree Exec Ed program. Today, we are pleased to have Professor Jennifer Blouin, the Richard B. Worley Professor of Financial Management and Accounting, to talk about her most recent line of research around taxation. We hope you will not only find this interesting and useful, but that it will also give you an idea of how professors bring their research into the classroom. Professor Blouin studies taxation in many contexts, including capital structure, asset pricing, payout policy, and multinational firm behavior. She teaches all levels of students at Wharton, including undergraduates, MBAs, PhD students, and including executive MBA students, to whom she regularly teaches an elective course, Taxes and Business Strategy, to our second-year students. And she's an award-winning teacher. Among her awards are the Teaching Commitment and Curricular Innovation Award, the Excellence in Teaching Award from both MBAs and Executive MBAs, and just last year, she won the highest teaching award at the University of Pennsylvania, the Lindback Award for Distinguished Teaching. Here today to discuss what executives need to know about the future of taxes is Professor Jennifer Blouin.
Well, thank you very much, Peggy, for that kind of introduction. So, it's always interesting when we start talking about taxes, particularly in an election year, and also we have in the spring term, right? And issues we have right now is what's going to happen. I think a lot of folks are interested and what we can expect with the current administration. So I want to spend a few minutes, at least initially, more or less going over the existing regime and talking about business taxes, but also about taxation on individuals, because as many of you know, individuals themselves are engaged in taxation or tax activity. Okay. So the basics of our US system, just roughly, is, as you all know, I'm sure already, that individuals and corporations are both subject to tax. In the US, currently, individuals are subject to what we call a progressive system, and that as your income increases, you pay greater and greater rates. Before 2018, our corporations were also subject to a progressive system, but since the recent more recent tax legislation in 2017, our corporations are subject to a flat 21% tax rate. Individuals, you are all, if you are a US resident, citizen, resident alien, are required to pay taxes on your global income. Doesn't matter whether you earn income outside of the United States, in the UK, someplace in South Africa. If you're a US resident, you are required to put that income on your tax return. Now, corporations are not that way. And I put the question mark here because, again, before 2018, they technically were also taxed on a global perspective. But now the US system has a somewhat hybrid method that is creating a lot of complexities and arguably confusion. And I'll talk a little bit more about that later. In terms of the US tax system on corporations, because this does vary across the world, is that the US corporate tax regime is subject to what we call a classical system. That means they're double taxed. The corporation itself is a separate legal entity that is subject to tax at this 21% I just mentioned. But then you, potentially as shareholders or whoever the owners of the corporation, the equity of the corporation, are then taxed again as they receive some return to owning that capital or investing in that firm. And so it's a classic double tax system, but at least in the United States, we provide a lighter rate, a lower tax rate on this second layer of tax, which we consider its capital gains or dividends type income. However, and what I think somewhat more of a focus of what today's talk is going to be, is I want everybody to recognize, and we need to start the discussion, that all business income is not in corporate form. It is not a traditional C corporation. In fact, a very significant part of the US productivity is in what we would call a pass-through or a conduit. And these types of entities are things that you may be familiar with, such as partnerships or limited liability companies, but also things along the line of S corporations and then real estate investment trusts, REITs. Additionally, if you're running your own consulting firm or sole proprietorship, you too are effectively under the guise or under the regime of what we would call pass-through taxation. So to give some examples about how these systems work and what the differences are in terms of generating after-tax cash flows, I thought I would take a very basic example comparing a corporation to a partnership or an LLC. And any method of conduit entity is treated as this partnership bucket. And so in a corporation, if you say earn $1, you'd be subject to 21% of the corporate taxes, and that would leave 79 cents in the corporation of what we call after-tax cash flow. The corporation then can choose to pay a dividend. And so that's why I asterisk there. That's actually a choice. But on the other hand, a shareholder may choose to sell their appreciated share of stock. And in that case, they would trigger the second layer of tax, currently again 20%. And so there would be 16 cents of tax being paid by the shareholder. And so 63 cents would be after all corporate taxation. As we would say, you lose 37% to the tax regime if you are organized as a corporate entity. Pass-throughs, on the other hand, the entity, the legal entity itself isn't taxed. The owners step into the shoes of the business and they report the activity of the partnership or the conduit on their own personal return. And so the income reported by the partner is whatever the business income of the entity is. And I assumed right now a 37% personal tax rate, that is the top, as of today, personal tax rate. And so the partnership in this case would effectively pay 37% on its earnings, right? Because this would be the cash tax that would the shareholder or the owner of the partnership would be responsible for, generating, interestingly enough, a 63 cents of after-tax cash flow. So under our current regime, it appears that corporations and partnerships are taxed similarly. But that's not necessarily the case, as I mentioned, because the choice to pay out a dividend is just that, it's a choice. So what I thought might be interesting to do is let's step back and talk about the sources of US tax revenue. So when we come back and say, okay, well, how much of the US revenue is really generated by the income tax? First and foremost, I thought we'd start there, and it turns out only about 60%. The remaining 40% is predominantly Social Security. So whether you think of that as a tax or a savings plan is personal choice, but I will tell you that the government relies heavily on that revenue to manage its operations. What I'm going to do is unpack a little bit more is just the income tax component of our revenue. And what the red represents here is the percentage of GDP that's a function of corporate taxation. And notice that this has been declining, some might say precipitously, since the early 40s, whereas it appears that the US individual income tax has stayed fairly high or fairly level over time. And many policymakers, public press, and alike look at this graph and say that this is evidence of what we call the degradation of the corporate tax base, that somehow corporations are ceasing to report as much income as they ought to have, that this business income is not being reported or is somehow being evaded or avoided. But I think it would be useful to go back and make a couple considerations about how entities might be classified by looking at historical personal and corporate and capital gains tax rates, or dividends tax rates in this case. And so if we go all the way back to 1950s and 60s, you can see that the top personal statutory tax rate really was up at 70 to 90%. And we've heard some recent progressive Congress folks argue that maybe we should go back to very high personal tax rates. After all, we were there some years ago and the whole world didn't collapse. That said, I would make the argument that, you know, those tax rates weren't necessarily paid because of planning opportunities, in terms of there was a much more opportunity to take deductions. But even ignoring who was actually paying, you know, those few individuals that may have actually been paying the 70 or 90%, I think it's an interesting exercise to recognize that this column with the top personal tax rate, that is where your partnerships or sole proprietors, that's the rate at which their income would be subject to tax, right? So if you're running a business through an LLC or a REIT, the income is being taxed at personal rates, not any sort of special business rate. So if we want to really make a comparison between conduit taxation and corporate taxation over time, what we need to do is combine that corporate and capital gains tax rate to figure out what would really be the aggregate rate on corporate income if we were to operate as a corporation versus a partnership, which the personal rate represents. And as you go through over time, you can see what used to be is that there was a preference to operate your business in corporate solution in terms of taxation. So back in the 1950s, if you owned a partnership, right, you would be taxed at 90%. But if you organized and put that business income into a C corporation, your effective tax rate's only 74%. But what this meant is there was a lot more business income in corporate solution. And so over time, as we move through into the Reagan years, all of a sudden this preference flips. So what we begin to see is that more income, more of our business income, we would probably like to have in pass through, because in Reagan 1, which is the 1981 change in tax policy, the top personal rate was only 50 as compared to the aggregate corporate rate of 57. And so as we get on to today, you can see what has happened is part of the reason why there is less and less income in the red is because more and more business income is actually in the blue bucket because it's being reported on individual returns. So Mirana, I have my first poll. If you could please give the participants, is I want to ask on average, what, I guess in aggregate, how much do you think of the US business income is actually on corporate returns as of today?
Great. Thank you, Jennifer. The poll is up. The audience is currently voting, so we're going to give them 30 more seconds to complete. We're almost there, almost. Our audience voted, so a few more seconds before we wrap up. Okay, great. I am closing the poll now, and the results are 17% voted for 10%, 55% for 25%, 16% for 45, 9% for 65, and 2% for 80.
Great. So, okay, so how do I get back? I guess this just popped up. I can't get rid of this. So the punchline is the 45% have it, right? So this is the results. This is actual published information from the Tax Policy Center. And so as of 2015, which is their most recent data analysis, it turns out that only 45% of US business income is now in C corporation solution. So this explains why so much more, right? Why the corporate collections seem to have declined over the past 70, 80 years. It's just the preference to now be in a conduit or a pass-through or single layer of tax entity. All right. So that's kind of a history lesson of where we are and how the current system works. So I'm sure most people probably signed up to say, well, what's going to happen, right? This is really what we want to know, is the future of things to come. Well, about the one thing I can set up with certainty was today's front page of the Wall Street Journal, I think nicely motivated my talk. We have a $21.6 trillion debt deficit and essentially is growing, right? Or excuse me, debt burden, and it's growing. So I can pretty comfortably say tax rates are going to go up. I don't think anybody would bet against me on that one. But what remains to see is how quickly this will happen, given all of the divisiveness, I think, both in the House and the Senate, as well as the residual issues with COVID. What we've seen is that I can talk widely about what was on the president's elect platform. And the corporate tax rate seems to be the focal point, or one of the larger pieces of revenue raising proposed. And that is going to take the US corporate tax rate up from the 21% we've talked about to 28. There's also a proposal to jimmy the overseas taxation, which again, I'll talk about a little bit later, but they are going to provide some incentive to corporations to now manufacture or produce domestically something which they had previously, or which had been in existence before the 2017 tax legislation. So there's a little bit of gimme there. I think some of the biggest changes, though, are high income individuals. And not going to argue about income inequality or what the appropriateness here. The reason I'm going to focus on high tax rate or high income individuals is because, as I mentioned, part of the reason why these individuals have high income is because they might be operating a business as a conduit. So the income is being reflected on their personal tax returns. So their income tax is going to definitely be increased for this group. Because we're going to first increase the statutory tax rate from 37 to 40%, which has been that way in the past. That's not terribly surprising. The big change, and rather significant change that I find a little bit concerning, is that for anybody with over $1 million worth of income, the top statutory tax rate on capital gains is going to go all the way up to their top personal statutory tax rate of 40%. Plus, there is the 3.8% add-on to help us fund Medicare or Obamacare. And so the top effective tax rate going forward on capital gains taxes could be 44%. This is going to be somewhat, I think, much higher than it's ever been, and this would be a pretty significant revenue raiser, but it also dampens incentive to perhaps invest in capital generating or income generating activities. And then again, another area of significant revenue increase is going to be the removal of the cap on Social Security for anybody with salary income, and that includes self-employment income, much of which shows up through conduit operations on income of over $400,000. So this is the big revenue types of things. Much of the focus and the dialogue surrounding this is because it's business, right? It's attaching incremental tax to business. But isn't that just taking away what we just gave firms, right? Didn't we just make the whole argument that we should have the Tax Cuts and Jobs Act of 2017 to help incentivize business, right? But it was very, very narrowly passed. So the, very, in the Senate, 51 to 49, and again in the House, it was very close. So the last major tax reform we had before 2017, we had to go all the way back to 1986. And in 1986, it was a Democratic-led House with a Republican-run Senate. But notice, even in the democratically run House, there was still a broad majority of folks crossed the aisle and agreed to vote for tax reform. Since we didn't have that with the 2017 Act, there's many people who are uncomfortable with some of the provisions and have desired to make some changes. Lots of controversy also surrounds the very high economic cost that was argued for the TCJA. And again, the big ticket item was that reduction in corporate tax rate. But I will challenge you to think about this a little bit more offline, is to recognize that when you aggregate all the different provisions up that were granted, right, the benefits that were granted to both individuals and corporations, the majority of the benefits did go to individuals. Of course, it was to high tax rate individuals. And so this kind of set up the dialogue that had been surrounding the Tax Cuts and Jobs Act, for which there's still a little bit of hangover today. Now, what were the effects of this reform on the economy, right? That's really what we wanted to see, and really where people are a little bit upset is they wanted to see the rate cut goose the economy. There should have been incremental investment. There should have been more investments. But one of the big centerpieces beyond the tax rate cut was the implementation of something called bonus depreciation, which is theoretically to incentivize firms to buy more capital today, because the US government will allow them full tax deductibility today rather than spread it out over 5 or 10 years. The problem with these temporary measures is what they do is they don't really incentivize that much incremental investment. It just really, what we've seen in the research is that it incentivizes firms to merely move some of this investment into a period where they would qualify for this benefit. And so it's intertemporal in nature, where we're really looking to have an effect on the aggregate amount of capital expended and the aggregate number of jobs. The other tricky side of tax reform is how much does it really cost? Each of these budget line items that I had, the $1.3 trillion worth of cost for reducing the tax rate from 35 to 21%, assumes a lot of items. First of all, do I just consider the fact that, well, if there had been $1 billion worth of income tax today at 35%, I reduce the rate to 21, right? That's going to effectively cost a net of, roughly the $140 million worth of difference in taxes. Well, no, because if we understand economic theory, lower taxes should incentivize more investment, which grows the pie. And so this is where some of this estimation of how much things should cost not only includes static revenue generation estimates, but also dynamic revenue generation. And this is, we have to get models or estimates or calculators to do this that requires or includes a whole bunch of hypothetical activities or actions that may or may not take place. For example, if you're going to tax red shirts, you have to consider that, well, what happens to the sales of blue shirts, right? Do they uptick? And how would that affect the aggregate revenue collected from a tax on red shirts? And this is where, when you look at one estimate or cost of changing the regime, you might see 3 or 4 estimates of cost, because they assume they also not only assume this dynamic scoring or how behavior changes, you also have to recognize, well, do I consider other pieces of the legislation and the overall aggregate cost? And so it got tricky, right? Because there was a lot of activity that changed in 2017, but the focal point was jobs. Recognize that jobs was in the title of this specific piece of legislation. And, well, what happened? Well, we've got 2 years, right? We've seen 2 years. And what we've continuous to see in the press is that the argument has been made that corporations, not workers, are the beneficiaries of the tax legislation. My favorite article here was that the growth cost taxpayers $4 million for each job. And then finally, that the economic effects, right, are nothing to do ultimately with jobs creation, right? They're just filtering out to changes in tax collections. But it is really, really difficult to say taxes change and jobs move, because there are other activity that are happening. For example, COVID happened in this period when we're estimating the impact of this 2017 legislation. So it's very difficult to sort of figure out what the true implications are in what I would call isolation. But unfortunately, we haven't had a lot of time, and we've had a lot of controversy, political controversy. And so what we've stood aside and said, well, due to COVID, we need some relief, right? We need to figure out a way to stimulate the economy. And so now what we've seen is an incremental $1.9 trillion worth of spending that's going to help goose the economy and move us forward. But remember that growing debt burden? So we somehow need to pay for this. And that's what we're looking for. We're not going to give tax legislation enough time to maybe percolate. We're going to just need to think about looking for additional sources of revenue. Here are the list of all those potential proposals that were on the president-elect's platform and what the estimated cost is for each one of these pieces. Notice that the largest single revenue raiser on this list isn't to corporations, it's to Social Security, right? So that Social Security, changing the rules such that any salary, whether it be salary or self-employment income of over $400,000 raises $740 billion worth of taxes over the next 10 years. So the 2.1 anticipated trillion dollars worth of revenue raised by the president-elect's proposed changes is almost squarely falling on high income individuals, but probably a lot of self-employment income in addition to business income and corporate solution. So the tax increase from 21 to 28% is $730 billion. And then the other large ticket item is going to be, again, this tweaking to our international regime. Any individuals with salaries less than income less than $400,000, in aggregate, this group is going to actually receive a roughly $600 billion worth of tax reductions over the next 10 years. So it seems like I'm not going out on a limb by making the argument that I anticipate business income taxes will be going up quite a bit in the next several years. So why are the majority of tax rates hitting business income and specifically corporations? In addition to the not quite fully realized anticipated effects of the Tax Cuts and Jobs Act of 2017, I believe that corporations have been vilified in the press and public as being very aggressive tax planners. Now, don't get me wrong, there are clear examples of situations that I would definitely put in the dodgy category, but on average, we have to ask ourselves, are companies truly out there doing illegal or even evasive type of activity? And it's not clear that they are. But this whole press push, I put back to the Starbucks example, and this is one of my favorites, the way this was uncovered. So it turns out that the UK, I believe, is Starbucks' second largest market in the world, which is somewhat humorous as it's a country of tea drinkers. But Starbucks had been disclosing in their financial statements and then their press releases and their earnings announcement that they had had over, I think, a several year period, over $3 billion worth of sales, 3 billion sterling of sales in the United Kingdom. In the United Kingdom, information about Starbucks corporate activity in the UK is publicly available. So a very astute journalist was able to procure Starbucks UK standalone financial statements, and they found in the past 14 years, Starbucks had only paid 8.6 sterling, to the UK's Treasury authorities, the HMRC. And it led to a very public boycotting of purchasing Starbucks coffee. So Starbucks was taken aback. They had released a whole host of articles and press releases saying, we're not under audit for these particular issues. There's been, the tax planning that we've undertaken has been blessed by the tax authorities. Everything we do is legal. But because of the court of public opinion, it turned out that Starbucks voluntarily, I guess, arguably, made, I think it was 20 million sterling of tax payments to HMRC. They told the public, we hear you, we understand, even though we're not doing anything wrong, we're going to pay this extra amounts to HMRC, and they did just that. Arguably a marketing ploy to help folks quit boycotting purchasing Starbucks coffee. Now, I didn't see anybody picketing the Apple store because I think Apple was like, yeah, feel free to not use your iPhone. It was just unlikely to happen. So what we see, the more retail facing that corporations are, the more sensitive they've been and the more vilified they are often in the press. Of course, Google, Facebook, and the like, right? This is just an even more recent article from last fall arguing that these organizations aren't paying sufficient taxes in more lightly taxed poor nations or third world nations. A lot of Action Aid and non-governmental organizations are trying to figure out how to simply force these organizations to increase their tax collections. And then this is a commentary on the fact that once we did have US tax reform in 2017, Apple was the big, I don't know if you want to call winner, but they paid $40 billion in taxes to the US government associated with the change in the international regime. But you can see the tenor of the press was, even though they paid that amount, what it meant is they must have been done something poor in the past. And so this, I think, is part of the reason why we see so much of the corporate angst or corporate welfare type tone of activity in the press. So now I want to open to the next poll. So Mirana, if you could pull up the third poll we talked about, which I want to ask you, the participants here, how you would define tax avoidance or evasion, or where you view the line on ethical type of tax planning activities. And so what I did was include a series of 4 potential avoidance techniques, if you want to put it that way. And of course, then an option to not answer it for any of those about what you think constitutes bad behavior in terms of tax planning.
Perfect. Jennifer, the poll is up.
Great.
The audience is voting as we speak, so we'll give them a few more seconds to respond. The answers are a bit lengthy, so we'll just wait a few more seconds before we close. Okay, so we're closing the poll now. And here are the results. 15% would build a factory.
Okay.
20% would negotiate with the government. 25% would claim tax deduction. 15% time machinery purchases, and 43% none of the above.
So I learned a lot about who's obviously working or planning inside the organizations from folks' response here. So let me see if I can get it. It's always hard to get this. There we go.
Yeah, just go back to the, okay, perfect.
Perfect. Yes. So how are companies avoiding taxation? So these are just articles I've pulled up recently that says how Fortune 500 companies avoid paying tax. And every year, The Fortune 500's financial statements are critiqued or evaluated by various groups to ascertain whether these companies are paying taxes. And every year there are some group of firms who aren't paying taxes. And the reason is these 4 items often. So the first is foreign subsidiaries. So maybe these companies aren't paying the top US statutory tax rate because they're paying taxes in a more lightly taxed jurisdiction. And I'm going to pick on Ireland, who has a 12.5% tax rate. So that's why they aren't paying any taxes, is they've moved income offshore. Then there's 2 and 3, which always surprise me. One is depreciation. So companies currently aren't paying any taxes because they are taking this dodgy depreciation. But what that means, they're not paying taxes, is because they've made a very large cash outlay, to pay for capital equipment that then the government merely lets them all take a deduction today instead of over 5 or 10 years. So it might reduce taxable income today, but it's kind of a one-time only, or it's an unusual transaction, but some take issue with that. Stock options. So equity compensation is also a big area that reduces companies' taxable income. And as many of you may recognize, is the choice to pay employees via equity versus cash is still compensation. And therefore, the IRS recognizes that whether you pay in equity or paying cash, that is still compensation and therefore should still be deductible. But the better a company's stock price performance does, right, the greater or better their stock price performance, the greater the potential value of the equity and the greater the value of the compensation deduction. And Amazon has all sorts of issues with this, and they commonly are in this list of avoiding companies because their stock has done so well. And then finally, there's a number of industry-specific shocks: oil and gas, real estate, etc. Another tone of this article, this is just a follow-up, is how 500 companies, at least this one, made the argument that these companies are legally avoiding taxes paid. And then real estate, of course, I would argue for those of you out there, is the most tax subsidized industry in the United States, and that they have the title of the loopholes, help moguls avoid tax. And it's not until you get to the 3rd or 4th paragraph of the article highlighted here where they point out again that these are all legal. So back to our survey, I think the argument that's been made, the 43% of you that said, hey, these all seem reasonable, it's actually true, they are all legal. Now, what we begin to get a little bit nervous is when you start anything that senses or smells of a negotiation, that there's something where only one company gets it. That to me tends to be more of a maybe a more aggressive types position, and it seems that's where the law might come down against the company. But I agree, we have a very kind of almost distorted sense, at least the public does, about what really it means to avoid taxes, and is that really a bad thing? Now, of course, as much of these companies, right, get flogged in the press about not paying their taxes, the punchline is here is it's not the company's fault. They are generally following the rule. On average, companies are following the rules of the land. US public companies, any large multinational companies, don't want to do illegal activity for a whole host of reasons, that which being it is illegal and it's wrong and there's penalties associated with doing it. And so the conversation really needs to be, if you want Google to pay more tax, then change the law. And that is exactly what the EU is currently doing or considering. So it turns out that there's a very famous, lengthy, what we call illegal state aid case that Apple has been engaged upon. And all this came back to is Apple chose to put a lot of its income in Ireland. And it negotiated a situation with Ireland that established essentially Irish law. And the rest of the EU member nations wanted to argue that Apple unfairly received something from Ireland, Ireland agreed that with Apple that it didn't, create a particularly advantageous situation that only applied to Apple. Ireland was an equal opportunity tax plan or opportunity location. And so it made the argument that, hey, everything that Apple could do or does, any other multinational also has the opportunity to do. And so, of course, the EU disagreed, but it turns out that the tax court fell on, decision fell in line with what both Apple and Ireland was arguing, is that no, there was no illegal state aid and there were no problems. So, but what it started to do was put pressure on Ireland and put pressure on countries that had loopholes or legal loopholes. And so one of the areas that they put pressure on was Ireland's creation of the thing called the double Irish or the Dutch sandwich, which facilitated a lot of these really low amounts of taxes being paid, particularly in Ireland. What we've seen then is, how do we continue to do better? We can't just stamp out, one tax planning opportunity at a time. And so we've begun to think more, and where I think we'll see a lot of changes come down the pipeline in the next couple of years is reform in the international regime. There's competition as the economy has declined for the revenue dollars of multinational activity. Everybody wants a bigger piece of the pie. But there's two big problems with the current system. First, the current system that the US developed and much of Europe and the OECD adopted since in the 50s, 60s, and 70s was based on law written in 1954, where there was no way at that point in time anybody could conceive of the value of the intellectual property being created, right? And how much value would be attached to the technological developments at that point in time. So therefore, all this transfer pricing rules just really aren't set up to capture easily or distribute easily the income associated with intellectual property. So transfer pricing in 10 seconds, put income in jurisdictions where taxes are low and expenses in jurisdictions where taxes are high. If companies have very mobile capital, like intellectual property is, because it's a piece of paper, they are much more able to engage in such activity. This results in what we call the race to the bottom. That's what we see with Apple and Google and tech and Starbucks, where they made the argument that the value is in their roasting and their brand name. They put all that intellectual property in low tax jurisdictions like Luxembourg and pay royalties there, which moves the income out of, say, the United Kingdom and a 20% or 25% tax rate to Luxembourg, which is a 0% tax rate on royalties. The other item that could not have been foreseen back in that period was the rise of the digital economy. And this is that folks are buying online. They don't need to physically be in stores. This has an issue with regard to not only income taxes, but also sales taxes. And this led to the, kind of groundbreaking Wayfair case and why we pay sales taxes on all of our eBay and Amazon purchases now. But it also has an effect now on how do we source income taxes. There is now creation of value, right? People click on their computers and buy goods all over the world. Well, is it fair that France doesn't get a cut of the pie when somebody buys a good that's sold from Ireland? Or even further, what happens when the value created isn't a physical sales flow, but because there's revenue to be generated on exploiting the data collected because that individual clicked on Google in France. And this is where we're moving. We're trying to adapt a system that can somehow collect revenue. And but unfortunately what's happened is in the hunt for revenue, US multinationals are squarely in the sights of most of the rest of the world. And this digital services tax, or the Google tax, is exactly going for that. It is exactly what it sounds. It's going to try and attach and tax revenue, because they can't figure out what the profitability is if I click on Google in France and I see an ad, right? So they're just going to say, hey, listen, nope, there's revenue being generated in France by Google, right? So we're going to place a percentage amount on that and try to collect it. Huge accounting issues. So what happens if I'm a French resident in Ireland back using my computer in France, right? Is it an income tax? There's all sorts of treaty issues. And then finally, this is what really gets US firms goat. The threshold for assessing this tax is 750 million euro global of global income, which carves out most other countries' tech type companies. All right. Just as of today, half of the OECD member nations are working on implementing a DST. We have had the proverbial back and forth with France, where we're going to put tariffs on French luxury goods if they move forward with their DST, and they are the country that is the closest to moving forward. In fact, they have started collecting it. So just a few more minutes remaining here. I wanted to point out is the US anti-abuse regime. Part of what we changed to try and combat this race to the bottom is we put it into two things that I thought were very cleverly labeled, called the BEAT, the Base Erosion Anti-Abuse Tax, and GILTI, the Global Intangible Low Tax Income. I want to talk about GILTI because this is the tax that has captured the EU's and the rest of the world attention. What it is a global minimum tax. It says because companies generate revenue out in lightly taxed jurisdictions, if you aren't paying a sufficient amount of tax on your income offshore, and right now the rate's roughly 13.5%, then you have to pay the difference between the tax you paid in that foreign jurisdiction and 13.5%. So you pay the delta into the United States. It's called GILTI. The problem is it has nothing to do with your actual intangible intensity. The tax is assessed on any return on assets in excess of 10%. So you take your physical assets, your tangible assets, and you multiply by 10%. If your taxable income exceeds that amount, you owe GILTI. And there was lots of interesting examples of Otis elevators, Kansas City Southern Railways being slapped with GILTI, even though they don't have any intangible intensity. This is one of President-elect Biden's revenue raisers, is increasing this GILTI tax rate to at least 15, if not 21%. So that means that US multinationals would pay more tax on their foreign activity. And so finally, the EU is watching this carefully. They've spent 5 years, believe it or not, trying to figure out how to change their international regime on this BEPS thing, base erosion profit shifting. The OECD looked at that. The EU looked at common coordinated consolidated tax base, which is an apportionment schedule like our state system. But over the past 2 years, the OECD has moved to something called the Pillar Blueprint. It's got 2 pillars in it. Pillar 2 is actually a global minimum tax like GILTI. But the problem with the minimum tax is all the revenue is assessed by the parent country of the multinational. It doesn't help France and Germany and the UK get a piece of Google's pie. And so the second pillar is a new way to allocate global income based on each country's market share. Huge accounting implications, huge implementation issues. These all should have been worked out in 2020, but unfortunately, COVID hit, and so they backed off working on this regime. But countries are very tired of waiting to get their piece of the Google pie, and that is why we've seen the uptick in the digital service tax. I expect this to be implemented some point in 2021. It will be interesting to see how the US responds. So in closing, what do I have to offer? Well, 2 years after the Tax Cuts and Jobs Act, who really are the winners, right? So let's throw away all the political rhetoric and just look at the data. And what we're starting to see is that it hasn't been all gloom and doom. There was some good effects of the TCJA, but it turns out that the real problem of our deficit and our growing debt is on the spending side of the equation. So I highlighted here, we can raise all the revenue we want, but we're never going to get back square on the debt framework until we can cut our spending. And that remains to be seen. So thank you very much. I'm open to questions. And then here's some information for everybody about our executive MBA programs.
Great. Thank you, Jennifer, so much for a great presentation. We definitely have a couple of questions that we'd like to address. So here's the first one. Curious to hear the perspective on impact of these higher taxes on the economy in general, equity markets, real estate, domestic consumption, as well as business incentives to staying domestic versus taking it outside, offshore.
Right, and so this is the $64,000 question, right? What really will happen? Now, one thing we know with certainty is when tax rates go up, right, that does affect the economy. People dial back. And I think there's a lot packed into that one question, but I think the real issue and why we have a hard time figuring out exactly what's going to happen to business, right? We can't put an exact, well, if the tax rate goes up by 25%, we think corporate revenues will go down by 25%. We don't know that because who bears the tax? Do people get fired because what companies want to do is maintain their bottom line because they want to keep returning their capital to shareholders? They want to keep maintaining their stock price because it's a currency in terms of purchasing other companies or raising cash to make greater investment. Those are all this kind of baked into that, what will happen when tax rates go up. I can with certainty say when rates go up, profits tend to go down. That's not hard to say, but by how much, we don't know. But it is generally not good news for aggregate productivity. I think one saving grace for us is the US rate will still be relatively low, where we were before the 2017 tax cut was 35%. Nobody was higher than us. Okay, that's not true. Maybe France, but nobody where you really anticipated setting up a manufacturing facility was higher than the US's top 35% tax rate. The EU was planning to, the UK was planning to go to 17%. So if you're looking at starting up a business, you'd give the UK due consideration. It is a 5-hour plane ride from New York. They speak English, and if their tax rate's 17%, I'd rather be there than the US. And so I think that's the big issue, is how much activity do we want to push outside of the US border versus maintain within the US borders.
Great, thank you, Jennifer. Here's the next one. Is there any hope of simplifying tax codes or laws to eliminate complex loopholes entirely, like postcard-sized tax form concept?
Oh gosh, wouldn't that be lovely? And everybody remember Forbes when he ran for president and the flat tax? I would be delighted if we would take something that simple and administer it, even though it would effectively plan myself out of a job, because who would need to take my class? But the issue is I don't ever see that happening, because what you would do is take Congress's ability to incentivize certain behavior, right, or redistribute wealth. A flat tax or a simple tax tends to be very regressive, because everybody faces the same tax rate regardless of your level of income. So when we start talking about simplification, that's usually where we end up with, and it's not terribly palatable. The problem with why things continue to be more complicated is we have however many sovereign nations, right? We can't, until countries are willing to coordinate, we will continue to have these cross-border or multi-jurisdictional loopholes. And I tend to think that is where much of our complexity lay. And as much as I would like to think we would sit around the campfire, hold hands and sing Kumbaya with these OECD projects, I just think it's unlikely. And so complexity is here to stay. The other problem or other reason why we end up with so much complexity is smart tax planners. If you give bright line tests, they will plan right up to the threshold, and therefore we have to adopt another set of rules to try and limit things that we really didn't mean to happen when we established the threshold. So if we could be more principle-based, that would be great, but then a lot of our work would fall to the courts. And I don't think we want to make our courts even busier at this point in time.
Great. Here is the next one. Do publicly traded companies ever account for tax increases when reporting quarterly earnings, comparing profit share between quarters?
Yeah, so that's an interesting question. So if you recall from 2017, the TCJA was signed by the president on December 22nd, 2017. And if there are any accountants out there like I am, we went, oh my goodness, you did not do that. Because what that meant is in the fourth quarter of that year, everybody had to accrue or account for the changes that would be coming down the pipeline in 2018 for the Tax Act. So you had 1,000 pages of tax legislation and 9 days to year end. So what we will start to see, depending once we get a tax bill, once the House and Senate put their bills together, get a sense of the likelihood of whether or not tax legislation will be passed. And once there is a bill circulating and people start voting on it, then companies begin to think or start disclosing about what the effects of tax reform will be on their financial statements. Once the legislation is passed, even though it might not be effective to the next calendar year, they have to accrue for that effect, and albeit whether it be annual or annually or quarterly, depending on when the announcement is made. Yeah, but yes, very long answer to the question that yes, they would have to potentially accrue for that into their financial statements.
Perfect. Here's one that's kind of, we got several questions around this, fairly similar. Has there ever been discussion of a global tax established with, say, a G20 framework where modern business interests can be addressed while allowing for sovereign fiscal policy to still incentivize growth within borders?
So I think the question is can we just set our international regime on a global level? So I think this is, if I understand the context of the question, very much what I have to do the CCCTB, the Common Coordinated Consolidated Tax Base that the EU, not the OECD, that the EU was proposing. What they would do is standardize, right, companies' taxable income. Because right now, this is the problem. How do we coordinate global taxable income where every jurisdiction has its own tax incentives, right? So France doesn't have bonus depreciation. So if we look at a US multinational company that has $100 million worth of taxable income before bonus depreciation and takes a $25 million bonus depreciation deduction, does France want to say, well, we don't get bonus depreciation, so we're going to apportion your $100 million, where the US would be apportioning $75 million? That's the problem with coming up with this coordinated consolidated tax base. How do we do that? By setting this global measure, we're effectively undermining each country's sovereign ability to incentivize growth or, investment. And that's where we talk about it, and it is, particularly academics love to talk about it. But when it comes down to feasibility, how we would apply it, it falls apart. It would really take complete coordination across however many hundred, what are there, 175 countries, tax regimes that we would need to coordinate in order to be able to do that. And that's where it just becomes nothing more than a hypothetical activity.
Thanks, Jennifer. I think we have time for 2 more questions. We definitely have plenty, but we'll share the remaining ones afterwards. So I just want to make sure we have a good use of time. Here's the next one. Is it inherently a regressive income tax in the US? And will US cities in the short and medium term be able to pay pension or be forced to go into bankruptcy?
So so the question is, are we inherently a regressive system? And did you say whose pension plans would be?
Will US cities in the short and medium term be able to?
Okay, well, yeah, well, this is kind of a separate issue because the cities, right, our municipalities and local government, they don't raise taxes for income taxes. They raise taxes from property taxes and what we call business use taxes. So that's kind of a form of a property tax. There are very few jurisdictions that have a business income tax. Now, Philadelphia, it turns out, does, and there are some other large municipalities, but that's not where the bulk of the revenue is being raised. The US system is inherently aggressive and I will probably anger people, but this is true, if we just look at the revenue raised. But what we have to recognize is if we look at the lower income, this part of the distribution, they receive a lot more benefits from whether state and local subsidies or the federal government through the earned income tax or other types of subsidies. And so when we begin to think about what is the net benefits, right? What is the net cost, tax cost that they incur? Is it really a regressive system? And I think the jury is out on that. What we do have to think about is we don't want to raise taxes on the top 1%, in perpetuity to the point where we incentivize these individuals to leave the country. You just can't do that. You also have to recognize that much of the very, very high tax income returns are one and done. They sold a business, right? They sold the family farm, I could tell you that way, or the company went public and they exercised the options that they've been holding for years. So does it matter which two of those stories? But that's where we come into to really thinking about how regressive our system is. I think we need to pay attention to the net wealth transfer to everybody in the tax distribution. And when we come to thinking about municipalities and their pension plans, some folks just need to cut a little bit more costs, or honestly, I do think they have to increase maybe some of the state and local property taxes to cover their pension obligations.
And here is the last one. Which upcoming tax year is most likely to be affected by the new tax laws?
Oh, wow. Okay.
This is
so
the one to wrap it up.
Taking bets on this, but I really think, I think 2022 is probably the earliest we're going to see, because we still need to get that 1.9 trillion, what's going to happen with the COVID type incentives. And I think we need to get that bill hashed out first before you can expect the incoming president to really put together some serious tax legislation. And the back and forth and just how split the Senate is, as well as the House, it just seems unlikely that Ways and Means and Senate Finance are going to be able to put something together and jam it through before late this year at the earliest. So I really think we're looking for an increase in 2022. And of course, many of you on the call are going to start tax planning this year to take opportunities of the relatively what might be low tax rates as compared to the future. So that's my anticipation, is I think something will probably come down at some point in 2022, because back to my favorite right here. It's not easy for me to go backwards. That one, 21.6 trillion and growing. Gonna have to do something.
Perfect. Thank you so much, Jennifer. Thanks for your time and for sharing these valuable insights with our audience. I would also like to thank all of you for attending the second Wharton webinar in the series of 3. We will definitely be notifying you of the third presentation in the weeks to come, and I wish you all a great rest of your day.
Take care, everybody.
Bye.